Hello and welcome back to the channel. If you're thinking about buying a home, refinancing, or just keeping an eye on your biggest asset, today's update is especially important for you. Oil prices have surged above $91 a barrel, the highest level since early June. This spike is driven by reports of Houthi attacks on tankers near Saudi Arabia and renewed tensions with Iran. The ripple effects are hitting multiple key shipping routes, including the Strait of Hormuz, the Red Sea, and the Caspian Sea. Why does this matter to you? Higher oil prices are feeding into renewed inflation concerns, which are pushing mortgage rates higher. Mortgage bonds have broken through important support levels and are now testing critical lows. At the same time, the 10-year Treasury yield has climbed to its highest level since January 2025. Unfortunately, this means borrowing costs for home loans are moving up, and rate and term refinances are slowing down. But here's some very good news for homeowners. Your home equity situation is incredibly strong. According to the latest data from Q1 2026, total home equity across all owned homes is roughly $34 trillion. For the 56.7 million mortgage properties, homeowners have built up nearly $18 trillion in equity. That works out to an average of about $311,000 per borrower. Negative equity homes are now down to just 1.9%. A dramatic improvement from the 26% we saw at the worst of the 2009 housing crisis. This shows how powerful home price appreciation and paying down your mortgage can be over time. Even with rates rising, most American homeowners still have a very comfortable cushion. That equity gives you options. You might consider removing mortgage insurance if you're eligible, looking into debt consolidation, or even tapping some equity strategically if you have high-interest debt elsewhere. Purchase mortgages remain the focus for many lenders right now, so if you're in the market to buy, working with a knowledgeable loan officer can help you navigate this environment. On the jobs front, the labor market is sending mixed signals, but initial jobless claims just dropped to 187,000, the lowest level since 1969. While that sounds incredibly strong, experts note that part of the drop comes from a major crackdown on fraudulent unemployment claims. The bottom line is, the employment picture is still relatively stable, which is generally supportive for housing over the long term. Looking ahead, the technical picture for mortgage bonds suggests yields could climb further toward 4.80% before finding meaningful resistance, unless we get some positive headlines on the oil and geopolitical front. Bottom line for consumers. Rates are higher today, so if you're buying, be prepared and get pre-approved. If you're already a homeowner, your massive equity position is a huge advantage, one of the strongest we've seen in decades. Stay patient, stay informed, and focus on what you can control. If you're a homeowner or thinking about becoming one, drop a comment below. Are you planning to buy, sell, or refinance in the next 6, 12 months? Thanks for watching. Hit that like button and subscribe for more straightforward housing and mortgage updates. I'll see you in the next one.